Richard, boy, oh boy, it's a tough time to be in the markets. Let me just ask you what's happening with investor sentiment. Is this based on fundamentals, or is this just a crisis of confidence right now?
I think that's both. There's both. I mean, there's some genuine concerns about the global economy. One thing that, I would point out was a lot of earnings reports in the second half of the earnings season here in the U.S. were very poorly received, especially the more globally, cyclically oriented companies like Caterpillar, some of the semiconductor companies. So there were, it was kind of lost amid all the noise about Europe and the debt debate in the U.S., but there was some genuine disappointments regarding earnings as well, even though earnings is really the kind of the bullish story. So you see both. I think you're seeing a total flight out of risky assets. You're seeing the riskiest stocks get hurt the most, but you're seeing kind of indiscriminate selling among those more risky groups. Energy companies that posted good results last quarter are going down, just like those who posted mixed results. So you're seeing, and now you're seeing second order effects where people are selling their exchange traded funds, they're selling their mutual funds, causing people to, managers to raise money, and that sets off another cycle of selling until you get to some positive news, I think, out of Europe, or stocks just get cheap enough where somebody comes in and says, this is too cheap to ignore. You're going to see continued pressure on stock prices, I would think.
There is panic on the markets right now, Richard, despite the fact that we got some would say some help from the ECB yesterday stepping into the markets to buy Spanish and Italian bonds, but yet no reaction. Why is that?
Well, it's kind of interesting. You actually see yields fall for Spanish and Italian bonds, but spreads kind of widen on French bonds. Some people thinking the credit downgrade in the U.S. is going to have a kind of a second-order effect where now France is going to be, their AAA rating could be jeopardized. I think you're also just seeing, I think the downgrade, S&P's downgrade did spook some people, and I think it definitely spooked some overseas investors in U.S. markets, even though, bond yields today in the Treasury market fell sharply. I think it just added to a sense of, unease, people not knowing what's going on. And I think the other thing that's worth remembering is 2008, 2009 is very fresh in people's minds. A lot of our clients were kind of right back to where they were at the peak, and they just don't want to go through it again. They don't want to go through all the pain, and they're heading to the exits. And, generally when people are thinking like that, it's an opportunity, but the question is, when do you want to step in?
Yeah, and that is a good question. When do you want to step in, Richard?
Well, we set our cash to a level where we're, somewhat on a long-term basis kind of indifferent to whether the market goes down or goes up. If stocks go down and you can take advantage of an opportunity, you can see it, 2-3 years out, I'm going to buy it even though I think it's going to be down in the next 8 weeks, those 10 weeks, those tend to be good buys. If you have belief in IBM at 10, 11 times this year's earnings, to me, would I rather buy Treasury bond or put my money in a bank, or would I rather have my money in IBM shares? If I'm looking out 3 to 5 years, I would still rather have my money in IBM shares right now. But where do you pick that spot? It's hard to tell. Some things we look at are, sentiment indicators, how bearish are newsletters, how bearish is option sentiment. On both those indicators, you still have a ways to go. You could still see sentiment worsen more. And valuations, while cheap, they're not rock bottom. You could see another 10 or 15% before people would be saying, wow, this is really cheap.
All right, Richard, thank you for sharing your insights. Rich Moroney of Horizon Investments joining us from Chicago.